This installment of the Anguilla Financial Services Commission's FinTech and Compliance webinar series was recorded on location at Maryvale Villa in Anguilla, British West Indies.
So hi everyone. On today's episode of the Anguilla Financial Services Commission FinTech and Compliance webinar series, we have Mr. Mike Killore from Ogiers BVI who's joining us today. And Mr. Killore has a background in dealing with fintech structures and incorporating fintech structures into investment vehicles. Good morning, Mr. Killore. How are you?
Good morning, and thank you very much for asking me to come along today to speak. It's a great honor, and I'm delighted to be here.
And we're happy to have you, and thank you for accepting our invitation. All right, so before we begin, I'll just let you introduce yourself to our viewers and tell us a bit about yourself and the work that you've done to date in the space.
Well, hello everybody. My name is Michael Killore. I am a partner in the BVI office of Ogiers. Ogiers is a global international law firm which first started about 150 years ago in the UK Channel Islands, in Jersey and Guernsey, and since then we've spread out across the world and certainly in most of the major international financial centres. Been in the BVI since as Ogiers, albeit we have roots going back before then, since about 2007. I am a partner in the corporate department. I'm head of the corporate department. My practice, at least when I joined Ogiers, was principally mergers, acquisitions, corporate reconstruction, shareholders arrangements. But recently, like a lot of folks in the legal transactional space, I've had to look at fintech, crypto, blockchain structures, because that is now, becoming an increasingly vogue area. And when people are developing those new types of technology, then almost hand in hand with those new types of technology comes the law. Either the law because those folks who are developing these structures want to use a vehicle, some form of corporate vehicle to put those structures in, whether as a fund or an issuer or some of the sort of new exotic things like LAOs and DAOs, which we can talk about later. But also they want to know that whether or not what they're doing is something that falls within existing financial services regulation. And those are my relations with clients, if you will, but also increasingly we are in relations with the regulators here, as say in Anguilla and across the world, because the financial services industry in the BVI is looking at the fintech in, I suppose, two different ways. One, it wants to encourage it, because it is a new business line and it is something that could generate income for the BVI, our involvement in fintech. But equally, it's something that needs to be considered on a regulatory level as well. What additional regulation does the BVI, or wherever these structures exist, need to put in place to control these, to ensure that they are being run by reputable people, and that folks who are investing in them are not about to cover cropper or run into trouble. But that's so certainly over the past 18 months or so, my practice has looked increasingly at fintech, which I guess brings me here.
Mm-hmm. All right. Well, it seems like you've been quite busy in playing your part in the space. And quite naturally, regulation and legal work, it basically marries into each other. So I guess that transition was a bit natural for you for, becoming involved in the fintech space.
I suppose the unique thing about fintech is that there is this inherent conflict with it, because the folks who promote fintech, and to some degree what it's all about, is the autonomy. So you don't have, you look at cryptocurrencies, you don't have a state issuing currency telling you how that currency works. There is no central player. Everything is run through the blockchain. But you don't have those controls, because they would say, well, you don't need those controls, because the blockchain ledger technology is such that you don't need that. You know, it is almost tamper-proof. It's corruption-proof in itself, because you've removed the human element, if you will. But on the other side, we have, as we should have, regulators, government saying, well, that's all very well, but this new technology, because it doesn't involve a government player or a central authority, in that case, maybe it can be used for nefarious purposes. So we do need to have a look and see what's going on. We do need to regulate it. Our job is to protect people. And if nobody is keeping an eye on how the blockchain operates or how the system operates, how are people being protected? So you do get these conflicts. The people involved in promoting this are not necessarily they don't necessarily want to be subject to regulation, but I think they have to be. So it's sort of trying to marry up that need to be autonomous versus, or the desire to be autonomous versus the need for regulation. And it can be a tricky thing to balance.
Definitely, I totally agree with you. And as regulators, we're trying our best to understand the space and to make sure that, we're not stifling the growth of the industry at the same time. So can you tell us a bit more about what other transformations you've actually witnessed through the introduction of fintech in the financial services industry?
It has many applications. I mean, a lot of the work that we do here at Ogier are probably aspects of fintech that you might not immediately think of fintech. So we've advised on a number of token issuances, not Bitcoin or cryptocurrency, but tokens. So folks have developed platforms on the web using blockchain technology. I mean, the thing about blockchain technology is that people think about coins and cryptocurrency. Blockchain technology can be used for lots and lots of different things that really have nothing to do with currency. Really, anything that relies on record keeping, ledgers, is open and prone to being improved by blockchain. Mm-hmm. So anything that anything that involves columns and moving things around and making transactions can be made more efficient, some people would say, by applying blockchain. So for example, share registers, titles. So if you're an organization and or a government organization, and you keep a record of who owns what property, like a land registry, then you can use blockchain to make that more efficient, to make transfers of title much more efficient. But sorry, going back to what we've been doing. So we've had people who've come along and developed innovative ways of, for example, making restaurant bookings. Something as simple as that, but using blockchain technology in order to do it. These restaurant bookings, not only can you make restaurant bookings, but on their technology, you can also get the reviews for the restaurants, and you can even call your taxi at the end of your meal. And they've developed a way of putting all of that together into a single system. And it's all autonomous. So there is no single person sitting there somewhere on a computer taking in information and putting out information. Whether the blockchain works is that it all happens automatically, and you don't have a person controlling that, because you have software codes written to manage all of that for you. Where do we come in? So they developed a system But in order to participate on that system, then you need to have a token, a cryptographic token. And so these entities, which we can set up in the BVI, they will issue the token for cash. So that's how the organization gets its initial funding, by issuing tokens to people who want to participate in that system. So they create the token, which is open ledger technology, blockchain, and the token itself can then be used on another example of open ledger blockchain technology, the actual platform.
Right.
These are quite simple. But really all the token gives you is a right to participate on that platform. And folks have used BVI companies for those token issuances. And they're increasingly actually using BVI companies for managing the platform itself, the entity that manages the platform that the blockchain, the real application sits in. So we see a lot of those kind of that kind of work, those kind of issuances, what we call utility tokens,
Right.
because the tokens that are being issued are not securities in the sense that I get a token and I can that token then gives me the right to some of the profits that are being generated by this system or other benefits. All I get is a token, and all that entitles me to is to use this system. Now that token may then itself have a value, but the value of the token is related not to the success of it is indirectly related to the success of the system. It has a value because if other people want to participate on that system, then they need to get the token, so they can. Well, and if the system is not issuing new tokens, the only way they can do that is buy the token from me. So then it starts generating a value. So if the platform is successful, they want to participate, they need to get the token. It's exactly the same way how money fluctuates in value, because it's just supply and demand for that token. And then that then brings you on to the other things that we've been looking at here recently, exchanges, because you have one platform that issues a token, and I might have the token for that platform, but maybe I want to be involved in another platform. So how do I get that token? Well, then you have an exchange. And what we're seeing now is that initially when these exchanges were set up, they were you were just exchanging one type of utility token for another type of utility token, and that's fairly straightforward. And it's probably worth saying that these utility tokens that we've been looking at until relatively recently are probably not regarded as securities or investments, and therefore not subject to the type of regulation that you might have if they were securities. So it's that in itself, it's a fairly simple process, but things are changing now. Things are getting a little bit more complicated.
And the regulators here in Anguilla, we completely understand, how the utility token work, because we have our very own Anguilla utility token legislation, as well as our utility token exchange legislation as well, which allows issuers of tokens, utility tokens, and exchanges to operate from or within Anguilla. You mentioned the example of the restaurant as a use case for utility tokens, which I find very interesting. But one of the different technologies I did not hear you mention that has so much potential in the space of legal work and investments is smart contracts. So what do you think about smart contracts being used in the legal field and in investments?
I think there is a certain there is a certain role for that. I think there will be some lawyers who will tell you that, you can't possibly have smart automatically executing contracts, because where two people come together to contract, they will naturally want to negotiate the terms of that contract. So how can you have something that doesn't require 2 or 3 third parties to sit there and help negotiate the terms of the contract? But of course, in real life, the world doesn't happen like that. Now, yes, lawyers will get involved to negotiate contracts, but typically only very large, very valuable, very complicated contracts. Most transactions that we have, some people don't always realize this, in fact, every transaction that we have day to day involves a contract of one sort or another.
Right.
It just so happens that you don't sit there and negotiate the contract. You might not even see the terms of the contract, but a contract exists. I mean, the classic example is also when you used to buy a bus ticket. There's a contract there. There are terms and conditions. You won't necessarily see them. You can if you go and look somewhere. But you don't need to have that negotiation for the contract. You know, smart contracts, that they have some fascinating aspects to them. I like the self-executing nature of them. Security to them, so that you know you have the coding such that in order for the contract to come through, money or I suppose it wouldn't be money, but crypto money has to move from location A to location B, and title to whatever the asset is that you're trading does not transfer until that transfer is verified. And when that transfer is verified, then automatically title to the asset can transfer as well, all under smart contracts, which are all automatically executing. And there should, in those kind of relationships, because you've sort of removed human error from the picture, and then you've also removed the potential for and misdealing. There's a certain beauty to them. So I think there is a tremendous value, and it would make all our lives much easier.
I agree.
Yeah. So we are seeing those. We're seeing those in. I was just looking at something in Canada where people were using smart contracts and open ledger technology for trading mining claims for mining companies. So if folks go out there, they explore some remote region of Canada and they stake a claim somewhere now, but they themselves don't have the capital and wherewithal to develop that, but they want to sell it on to someone else. But somebody developed a system for trading these claims in remote areas of Canada between prospectors, folks who'd actually found the whatever it was, and people then who were going to come in and develop and construct the mine. So we are seeing that. It's not just small things. It can be something as big and as physical as mining claims, which is fascinating.
Yeah, I think while the features of the smart contract are not identical to what legal professionals are used to in terms of a physical contract, meaning the negotiation bit and all of the different features, traditional features. I think that there's so much to gain and benefit from the use of smart contracts, and it's just a matter of time before all of the legal practitioners and other financial services players, so whether it may be in investments, in mutual funds, in insurance, at some point in time, what we deem as the norm or what we deem as traditional, it will be shaken up a bit. I mean, that's basically what fintech is. It's there to disrupt the financial services sector and just bring in something new and something fresh that enhances the products and services that are offered. So like I said, I think it's just a matter of time before these different practitioners accept that these are the new features, and there's so much more to benefit from this new thing, as opposed to sticking to the old.
I think that's absolutely right. And I think it's important that practitioners and regulators, I mean, we should be on our toes in relation to these things, but we shouldn't be afraid of them. They're not, if you're a practitioner, smart contracts, blockchain, fintech is not going to come in and like the folks in the 19th century thought when they put new technology into spinning machines and things like that. They're not going to take away jobs as such. They create different types of jobs, different ways of looking at things, different ways of doing things, which will actually be beneficial, I think, makes things much more efficient. And I suppose it's the same for a regulator as well. I mean, when you look at these structures, first of all, you have to get your head around them to work out exactly how they work. But then some of these structures that come out, they're not traditional. They don't have 2 or 3 people who are running them, individuals that you can regulate. That there's something different to them. But that doesn't necessarily mean they are criminal or they're being used for illegal purposes.
Right.
Yeah, there are, in some cases, yes, they are, but then lots of other different types of business structures that have nothing to do with fintech have been used for illegal purposes. But I think, on all sides, it's simply, this is new and novel. And so anything that is new and novel, you are going to be a little bit wary about. But I think we all have to somehow get our hands around them. And yes, they do. There is a need for oversight and regulation somewhere. I'm absolutely sure about that. But what there isn't a need for, I think, is to say, yeah, all of this stuff is wrong, and so we're just going to outlaw it, because I think that's not the right approach.
All right. So before we wrap up this session, I just wanted to ask you, what are your views on the essential factors for regulators to aid in the fostering of growth in the space while embracing their regulatory mandate for financial stability and protection, and protecting the public?
Yeah, that's the sort of the golden question, if you will, and I think I think where people get it right, it's a very difficult one to balance, is a light touch regulatory regime. No, not light touch, right touch, I think is what I'm looking at here. And it's where I think regulators and practitioners alike have to be well educated in blockchain, fintech. They have to know what they're looking at, and I think that's been a problem in the past where people just haven't understood it, and because it's new, and because there have been scandals, and because there is no central actor on these things, they've just assumed that there is something. You're looking it through a dark lens to start with. So I think on the regulatory side, folks need to be educated in it. They need to understand what it is. Same on the practitioner side. I know there are many legal practitioners I come across that don't want to get involved in this world because they see it as something that is they have the sense that there is something something that they don't necessarily want to be involved in, but I think that's mainly because they don't understand it either. I think we all have to be open. I think we have to understand what it is, because it's here. It's not going to go away. And it is more than Bitcoin. So we have to all get our hands around it. And on the regulatory side, you've got to be careful, because you over-regulate something in a jurisdiction, then you will drive it away from that jurisdiction. The fintech will exist. It'll exist somewhere, and better that it exists in your jurisdiction, appropriately regulated, than it doesn't at all, because jurisdictions will lose out if it's not there. And I think that the promoters of fintech, those involved in it, they themselves don't have, at least most of the folks I speak to, they don't have a problem with regulation. They understand that there is a need for all of society for some form of regulation of what they are doing. Because there are bad players out there, and that's always going to be the case. People will try and use this for bad ends. So it can't be a complete free-for-all. And most of the promoters that I deal with are happy to be regulated. And actually, it's a selling point for them, because when they are seeking investors, if they can show, or the structure they created can show, that it is subject to regulation somewhere, somebody is keeping an eye on it to make sure that this is not being used for bad ends, or people are getting ripped off, then investors feel safer. They're more inclined to invest into something that is regulated, or at least or subject to some degree of oversight. But you've got to balance it, because if you go too far and you make it too difficult for people to operate, then they won't operate in your jurisdiction, and they will go somewhere which may have no regulation at all, and I think everybody will lose there. So it's that balance. It's getting the regulation right. But in order to get the regulation right, it's important that regulators really understand and have a good grasp on what is. Can you hear me? What is being done?
So what I was saying is essentially, I'm gathering that you're saying that capacity building is very important, both on the regulators end as well as the players in the industry, making sure that they understand the different products and understand blockchain and how it works.
I think that's right. I think the folks who develop these systems, of course, they do understand blockchain because they built them. But I think it's the service providers and the regulators around them where it's important. So the regulator needs to understand what it is that they're dealing with, because if you don't understand what it is, then you're much more inclined just to, I don't understand it, so I'm going to say no, or I don't understand it, so I'm going to outlaw it, or I'm going to subject it to regulation that isn't probably appropriate, because I don't, if I don't know what I'm regulating, then I don't really know how I can best protect the people who might be dealing with it. So you'll either say either wrong regulation or too much regulation, and that'll kill it. And equally with legal practitioners and anybody involved on as service providers, they need to understand what it is. I mean, I can't advise in relation to blockchain structures unless I really know what it is that what's going on and how what they're doing interacts with existing laws. So it's a challenge, but it's like everything. As the world moves on, as economies move on, as technologies move on, those that will do well will be people who understand what the new technology is all about. You have to have some knowledge of it in order to use it and benefit from it. So you just got to keep abreast of developments and just always keep active.
I think, and that last part, that's very important. You have to keep abreast with what's going on, and this industry is moving so fast. It's moving like every minute, every second, something new is happening, it's changing. And what makes it a bit more challenging for service providers and practitioners as well as regulators is that it's something that's totally new. There's no precedent set. There's nothing set in stone that says this is what you must do, this is how you must regulate it. So we're developing regulations as time goes along, and as these things develop, and as we review them and see how they operate and function. So I think that's also a challenge. But like you said, that challenge can be mitigated by keeping abreast with what's going on in the space.
Absolutely, and it's a challenge, but it's also an opportunity. Right. Because this is new. This has not been seen before, and it's not been seen before not just in the Caribbean, in Anguilla or BVI or Cayman or wherever. It's not been seen anywhere else in the world. So it's almost like a leveler. It puts us all on the same foot. So regulators in New York, regulators here in Anguilla, we're all really coming at this at the same speed at the same time. So in a sense, it gives us opportunities if we in this part of the world want to focus on fintech, to encourage fintech, to get the regulatory environment right for fintech. We have an opportunity to do that now. We have the right people. We get the right people educated. Then we can be just as good in this space as anywhere in the world, onshore, offshore, wherever. So I think actually it brings opportunities.
And there's another opportunity that exists. I know that we didn't mention is the sharing of experiences. So the fact that somewhere across the pond they may have a different experience or similar experience to us here in the Caribbean, in Anguilla and BVI. And once we're put in a position or put in a place where we can share the experiences through, say, for instance, something like GFIN or any type of organization that allows different regulators and service providers to network and share their experiences. I think that as well is also a valuable opportunity for regulators and service providers, like I said.
And absolutely, and that's almost the story of new innovative fintech. Everything is open source, so it's everybody can interact. That's part of what this is about. But absolutely, the shared experience, shared knowledge, that has got to be a good thing. And today it is much easier to do that than it ever was before. So yeah, absolutely.
All right, Mr. Killore. So recently on Ogiers' LinkedIn page, you would have shared some information regarding special purpose acquisition companies and the market that's available for these types of vehicles. You would have been congratulated in that article for your work done with Ogiers in terms of SPACs.
Yes.
Can you give us some more details on your involvement in that space and whether or not you see a future for SPACs with fintechs and in fintech space?
Absolutely. And thank you for reading our LinkedIn post as well. It's good that in Anguilla you're following what we do. Just give everybody a brief idea of what a SPAC is, because not everybody knows. So a SPAC means Special Purpose Acquisition Company. SPACs are set up as newly incorporated companies by a group of persons, or one person, sometimes called the sponsor, and they put in some seed capital into the SPAC. And don't forget, again, a SPAC, it's a newly incorporated company. It holds no assets, no nothing. It's just been set up. That SPAC will then, or the promoters of the SPAC will find a management team, and they will put them in as the management team of the SPAC. And then they will conduct an IPO for the SPAC, which might seem a bit odd because you've got a company that then goes and lists its shares on a stock exchange and raises money on a stock exchange, even though, and you're asking people to invest in this, even though the company itself has only just been formed, it has no business, it has no nothing. But what investors are investing in are the potential of the management team that you've put in your SPAC to go off and find an existing business to acquire. That's why they're called special purpose acquisition companies. So they are established for the sole reason, sole purpose of going off and finding something else to buy. And the money that comes into the SPAC, and there's why some investors they're very attractive. People put their money into the SPAC. The money that goes in is put in a secure trust account that no one can touch. The managers go off, they find a target, and they have to find a target within a short period of time, about 18 months to 2 years. And only then can they use the money that's in the account to make the acquisition. If the SPAC can't find anything to buy, the money is given back to the investors. And in fact, in most cases, investors have the opportunity, even if the acquisition is going through, to take back their money if they don't want to be involved in the company post-acquisition. There are lots of other complexities to it, but that's sort of in a nutshell how they operate. Now, SPACs have been around for quite a long time. They have gone up and down in popularity for a number of reasons, but since about 2014, they have been becoming increasingly popular. And in 2020, for a number of reasons and a number of factors that all came together at the same time, SPACs have been enjoyed their best year on record. I think they've been almost over 100 or so IPOs just in this year, and it's probably 2 or 3 times more than any other year. So they're now quite a vogue, and they're being used not just by the people who traditionally utilize SPACs, but they're now being used by venture capital partnerships and private equity as an alternative to the traditional structures that private equity and venture capitalists used for acquiring things. Now, that's a SPAC, and we've done a lot of SPACs very recently. In fact, last week, I think I closed 2 SPACs in a week. Now, where do they sit with something like fintech? Well, they can sit quite easily, and in fact, we had a SPAC that I think it was January last year IPO'd. Sorry, no, January this year it IPO'd. And that SPAC was set up specifically to acquire an existing business. They hadn't actually identified what the company was they were going to acquire, because you're not allowed to do that for SPAC. But they identified the area where they were going to look at, and it was fintech. So the SPAC was set up to acquire an existing business, and they can certainly provide a way of getting capital into existing fintech businesses where perhaps the fintech business would have previously had to look for venture capital involvement or private equity involvement. This is another alternative, and a lot of the folks who are involved in SPAC, they also have an interest in fintech and new economy ideals. So I think certainly as a means of bringing more capital into fintech, SPAC could be a way of doing it. The other thing that you get with a SPAC is if you're acquired by a SPAC, then you end up with an exchange listing. Unless the SPAC delists, but you would then be a fintech business acquired by a SPAC, by virtue of being acquired by the SPAC, becomes a listed entity. Mm-hmm. Which I suppose then that raises some interesting questions about regulation, because you have this blockchain business where there's still some nebularity, if you will, between what it's doing and how it sits with regulation around the world. But its holding company is now sitting on a stock exchange, which will be fairly heavily regulated. So it's interesting now whether fintech could also be used in the sort of the mechanics of the SPAC itself, possibly. That's not something we've looked at, but certainly the increasingly we're seeing SPACs who are looking into fintech, looking into other tech. So we did a SPAC a year or so ago that invested in and acquired an Internet of Things company, an IoT business. So folks who are developing apps to control physical items and things like that, which is quite fascinating. The kind of things that you can switch your lights on and off at home from your office, or drive your car around the car park so it can pick you up when you got your shopping. Interesting things like that. But SPACs to some degree a new technology, and therefore it is only fitting that they'd be investing in new technology as well. So.
Yeah, I was about to add that this sounds like a space that is ideal for startups, and to take the startup to the next level.
That's quite right. In a lot of cases, SPACs are investing in startups in the same way that private equity used to. That if you were a startup and you wanted new capital and you didn't want to go to a bank, that's how you got it. You approached private equity. SPACs to some degree now perform the same service, and they can probably do it in a way that is less. It's less intrusive into the business that they're acquiring. So if a company is acquired by private equity, typically you are the management and the sort of the combined enterprise ends up with a lot of debt because that's how private equity operates. That's how it raises money, and then the business has to be run in such a way that some of that debt has to be repaid. The SPACs have a different model where that doesn't always apply. Mm-hmm. And so they are they can be I suppose, a little bit more forgiving on the target that they acquire. They can let that target develop more, if you will, before it has to be generating a very large profit or cost cutting in order to return funds up to the private equity to pay off debt. So yeah, I think for startups, and certainly startups in this space, a SPAC can offer opportunities that traditional forms of equity finance probably can't.
All right, so I just want to say thank you very much, Mr. Killore, for joining me today. I found that I enjoyed the discussion very much. And I want to say thank you again for accepting our invitation to present to our viewers.
Thank you very much indeed. It was a great honor to be asked, and I very much enjoyed speaking with you and being able to present to everybody. And hopefully we can do something similar again. And I look forward to when that may be.
I look forward to that as well. And thank you so much. All right. Goodbye.
Goodbye.
The Anguilla Financial Services Commission would like to thank OGIER BVI for their participation. Any references within this episode can be found in the links provided below. For more information on our FinTech licensed businesses, please contact us by email at innovate@afsc.ai.